Today, we're going to break down some of the confusing business and accounting jargon that you've probably come across, especially if you're running a business, freelancing, or just trying to get a handle on your finances. Terms like assets, liabilities, equity, they pop up everywhere, from balance sheets to business news. But what do they really mean in plain English? So hopefully by the end of this video, these terms will actually make sense and you'll be able to read your numbers with way more confidence. So let's jump in. There's one simple idea that sits at the heart of all accounting. Assets equals liabilities plus equity, or capital if you're a sole trader or self-employed. Now that might sound technical, but it just means this. What your business owns is equal to how it's funded, through debt or your own money. So everything your business owns, your cash, equipment, inventory, all of that has to be funded somehow. Either you put in the money or you borrowed it. That's it. It always has to balance. Let's break down each part of that equation so you know exactly what it means. Assets are basically anything valuable your business owns or controls, stuff that's going to help you generate income or run your operation smoothly. There are two main types. You've got non-current assets and current assets. So non-current assets or long-term assets, these are big things that you buy that last longer than a year. For example, if you're a baker, it could be your oven or industrial mixer. A photographer, it could be your camera gear. If you run an online business, maybe it's a laptop or a studio setup. You don't expense the full cost right away with a non-current asset. Instead, you spread it out over a few years. That's what's called depreciation. And it's just a way of recognizing that your equipment loses value over time. Also, when you buy these kinds of assets, that's called capital expenditure. But if you're just fixing or maintaining them, that's a regular business expense. On the other hand, with current assets or short-term assets, these are things that your business expects to turn into cash within a year. So you've got things like inventory, which is stock you plan to sell. In the case of a clothing store, for example, this could be t-shirts, jeans, shoes, etc. There's things like receivables, so money customers owe you. For example, a web designer sends an invoice for $1,200 but hasn't been paid yet. One thing I've noticed with small business owners is how easy it is to forget about receivables. You've done the work, sent the invoice, but because the money isn't in your account yet, you don't really think of it as yours. People say, oh, I guess I'm still waiting on payment from that job I did last month. That's a receivable. And it does matter because it shows up on your balance sheet as an asset. And keeping track of it can actually help you spot cash flow problems early. Then there's things like prepayments, which is basically stuff you paid for in advance, like insurance. Let's say, for example, you paid $600 up front for 12 months of business insurance. So only half of that is an expense for this month. The rest is a prepayment. And then also cash and bank balances. This is actual money in your accounts. Current assets are basically the lifeblood of your business's day-to-day operations. Now let's flip it. Liabilities are essentially what your business owes to others, suppliers, banks, the taxman, even customers in some cases. Just like assets, they're split into two categories. You've got long-term liabilities and short-term liabilities. Long-term liabilities are things that are debts or obligations you don't have to pay off for over a year. These are things like long-term loans, big equipment financing, or repayable investor funds. With regards to short-term liabilities, these are basically due within 12 months. So you've got things like payables, money you owe suppliers. For example, you receive stock from a wholesaler but agree to pay next month. Then you have accruals, bills you've received or services you've used but haven't paid yet, like utilities. This one I've seen always confuses people. Say, for example, this could be your business usage of electricity or internet used in December, but the actual bill for it arrives in January. Or you know your accountant's fee is coming at year end, but they haven't sent the invoice yet. Then you've got things like short-term loans or overdrafts and tax payable, things like income tax, sales tax, or VAT, depending on your country. Some businesses also set aside provisions for expected costs like refunds, warranties, or legal issues. But the bottom line is, liabilities are all about what's coming out of your business in the near or distant future. And now the last part of the equation is equity or capital if you're self-employed. It's basically what's left for you, the owner, after you subtract everything the business owes. Let's break it down for different business types. If you're a sole trader or freelancer, you probably started the business with your own savings. Every time the business makes a profit, that profit adds to your capital. If you take money out for yourself, which you can, that's called a drawing and it reduces your capital. If you run a company, your equity is made up of things like share capital, which is the money people invested in exchange for shares, retained earnings, these are the profits you've kept in the business over time, and dividends, money paid out to shareholders. This basically reduces your retained profits. In both cases, equity shows your overall ownership value in the business. The healthier your business is, the stronger that number will look. So why should you care about any of this? Well, number one, you'll make better decisions, like whether to reinvest in your business, whether you can afford to hire someone, or when it's time to raise your prices. Number two, you'll spot red flags early, like cash flow problems, growing debt, or falling profit margins. And number three, you'll stay organized for taxes and funding. Whether you're applying for a loan or just want to avoid tax headaches, understanding your accounts gives you control. So even if you have an accountant, this stuff isn't just their job, it's your business. So you should be confident reading your numbers too. So there you have it. Those are intimidating accounting terms explained in plain English. Remember the following: assets is what you own, liabilities are what you owe, and equity is your slice of the pie. And the better you understand these basics, the more confident you'll feel running your business. Thanks for watching. If you found this helpful, feel free to drop a like or share it with someone else who's trying to get their head around accounting. Catch you in the next video.